The S&P 500 and Nasdaq surged to near record levels following the release of July inflation data that came in slightly below economist forecasts. Investors reacted swiftly to the prospect of a Federal Reserve interest rate cut being more likely during the September meeting. The Dow rose noticeably as well, signaling renewed optimism across U.S. equity markets. Heavy tech and consumer sectors led the advance as traders priced in more accommodative monetary policy. This development has created renewed confidence among equity investors seeking growth opportunities amid easing inflationary pressure. U.S. inflation for July held steady at 2.7%, just below expectations, but core inflation unexpectedly ticked higher to 3.1%, marking its highest level since February. Multiple sectors responded positively, believing that moderate headline inflation may pave the way for upcoming policy easing. However, the rise in core inflation introduces caution for policymakers, who may delay rate cuts if pressures persist. Investors remain attentive to whether this divergence between headline and core inflation will impact central bank decisions. Market sentiment remains balanced between relief over headline data and concern about persistent underlying inflation. Markets also received a boost from the extension of the U.S.-China tariff truce for another 90 days, which dampened fears of an imminent trade escalation. This extension eased geopolitical uncertainty and supported asset prices across global markets. Equity indices in Asia rallied, especially Japan's Nikkei, which reached fresh record highs amid optimistic trade sentiment. Other markets in Asia-Pacific showed modest gains, signaling broad-based improvement in investor confidence. The extension creates breathing room for policymakers and businesses awaiting long-term clarity in trade relations. Oil prices edged higher as global energy demand expectations rose, supported by OPEC's revised forecasts indicating stronger consumption in 2026 amid limited supply growth. Meanwhile, gold prices declined moderately after President Trump ruled out any new tariffs on gold imports, reducing fears of supply disruptions. The contrasting movements in oil and gold highlight shifting commodity dynamics tied to policy developments. Energy markets gained bullish momentum, while traditional safe haven assets retrenched slightly following regulatory reassurances. These developments underscore the sensitive relationship between geopolitical news and commodity pricing.
In Asia, equity markets rallied broadly thanks to upbeat trade optimism and dovish central bank signals. Australia's central bank cut its benchmark cash rate to a two-year low of 3.6%, prompting initial gains in Australian equities. South China and Hong Kong markets also edged higher, reflecting improved regional sentiment. Investors are now more optimistic about cyclicals and commodity-linked assets following easing macro pressures. These responses suggest regional markets are positioning for a sustained economic rebound, supported by policy easing. The U.S. dollar strengthened notably against the Japanese yen ahead of the inflation data release, trading near 148.40 yen while maintaining relative stability against the euro and pound. Traders adjusted currency positions in anticipation of Federal Reserve moves, factoring in the possibility of a rate cut. The dollar index held firm near 98.48, signaling continued demand for dollar-denominated assets amidst uncertainty. Market expectations of a September Fed rate cut stand at about 94% probability, fueling speculative positioning across FX markets. Currency markets remain perceptive to policy signals and inflation trajectories. Investors have tread cautiously ahead of key CPI data, with U.S. stock futures largely flat and volatility subdued as uncertainty lingers. Market participants are walking on eggshells amid anticipation of inflation readings that could reshape policy expectations. Futures and ETFs are reflecting hesitation as traders await clearer macro guidance from upcoming data releases. This tempered environment underscores market sensitivity to shifts in economic indicators. The pause in momentum reveals how fragile confidence remains without decisive signals. Cryptocurrency markets experienced mixed movement, with global market cap momentarily surpassing $4 trillion before retrenching slightly. Ethereum continued to outperform, buoyed by strong ETF inflows that underpin its infrastructure narrative. Bitcoin, on the other hand, softened as investors rotated focus to smart contract platforms and token utility. Broader investor interest appears shifting toward assets demonstrating functional use cases beyond speculation. This divergence indicates maturing trends within the digital asset space.
Litecoin gained traction after breaking above $123, propelled by a notable $100 million institutional buying wave. The significant purchase created bullish momentum, boosting confidence in Litecoin's longer-term potential and token stability. Traders and analysts viewed this move as an affirmation of growing institutional appetite for diverse crypto holdings. The asset's breakout signals how capital flows are increasingly influencing altcoin valuations. Selective institutional interest continues to shape digital asset dynamics. A well-known semiconductor and blockchain developer firm recently expanded its strategic Bitcoin reserve by adding 13 additional Bitcoins to its holdings, investing approximately $1.5 million. This move is seen as a reaffirmation of corporate-level confidence in crypto as a strategic asset class. By diversifying part of its balance sheet into Bitcoin, the company highlights the growing acceptance of digital assets in corporate finance management. Other firms may follow suit as they seek inflation hedges and portfolio diversification. This initiative further legitimizes crypto allocation among institutional investors. U.S. Treasury yields moved lower, especially for long-dated maturities, as the dovish inflation data reinforced expectations for monetary easing. Bond market participants reacted predictably, pricing in more acute probability of rate cuts in coming months. This repricing signals growing market conviction in policy accommodation ahead. Lower yields are supporting equilibrium across asset classes by reducing borrowing costs and easing financial conditions. Fixed income markets are thus leading the narrative for broader investment shifts. European equities responded positively to U.S. developments and easing trade concerns, with futures indicating higher openings. Market participants in Europe are seeking signs that the Fed easing could reinforce cyclical recovery globally. Meanwhile, certain European software stocks faced headwinds due to rising concerns about AI regulation and heightened scrutiny. Markets are balancing optimism from macro drivers with sector-specific risk assessments. European investors remain selective amid a complex global backdrop.
In India, key stock indices such as the Sensex and Nifty moved lower following a volatile session, impacted by weakness in financials and banking stocks. Broader investor sentiment was dampened by mixed global cues despite regional equity resilience. Volatility across sectors persisted as traders processed a blend of domestic and international economic signals. Within Asia, this divergence underlines how localized dynamics still carry weight amid global macro narratives. Indian markets reflect caution amidst uneven recovery signs. Wall Street posted strong gains led by surges in major indices, with the S&P climb of near 1%, the Dow rallying over 460 points, and the Nasdaq gaining 1.2%. Tech leaders and cyclical sectors both contributed to the move, benefiting from renewed rate cut optimism. This rally underscores how powerful inflation signals can reverse sentiment quickly. Investors responded with rotation into growth stocks poised to benefit from looser financial conditions. The rally reaffirms equities' sensitivity to macro data. The labor market in the UK showed signs of strain, with wage growth slowing and job vacancies falling for the 37th consecutive month. Meanwhile, Thames Water is preparing insolvency contingency plans, prompting government intervention and financial advisories. These developments highlight underlying structural challenges within the UK economy. Policymakers may need to reconsider support mechanisms to stabilize employment and infrastructure sectors. Domestic financial markets are showing concern amid broader global macro improvements. Tech giants IBM and Google made public claims about near-term breakthroughs in quantum computing today, projecting potential transformations in computing performance. Such innovation announcements tend to spark enthusiasm in sectors adjacent to artificial intelligence, including semiconductors and enterprise software. Equity investors viewed the news as supportive of future productivity gains and technological edge. The trend reinforces long-term narratives around disruptive technologies driving investment. Markets continue to price future innovation potential into valuations.
Elon Musk's AI company, xAI, reportedly threatened legal action against Apple, accusing them of suppressing content related to Musk's social media platform and chatbot in their App Store rankings. This legal threat escalated tensions between leading tech platforms, raising concerns about antitrust and content control. Markets responded with increased volatility in social media and AI-related stocks due to uncertainty over policy and regulatory impact. Observers are closely watching how such disputes may influence sector dynamics. The clash underscores broader tech governance risks. The global cryptocurrency market is maturing, reflected in shifting investor behavior towards selective altcoin accumulation while staying vigilant on inflation-driven macro shifts. Infrastructure assets like Ethereum and Litecoin are attracting more mainstream and institutional capital. Meanwhile, traditional markets are reaffirming their sensitivity to inflation, trade, and central bank signals. Investors are strategically adjusting exposure across digital and traditional asset classes. These developments suggest a more nuanced and integrated financial landscape emerging globally. OPEC boosted its oil demand projections for 2026, citing structural supply constraints, which lent credibility to energy-focused equities and commodity-linked sectors. Oil prices rallied modestly as investors discounted future shortages amid geopolitical uncertainty. The revised forecast signals potential long-term tightness in energy markets. Market participants are now reevaluating valuations of oil producers and energy infrastructure stocks. Energy security concerns continue to shape strategic investment narratives. Finally, markets around the world remained in a wait-and-see mode ahead of upcoming U.S. consumer inflation, jobs, and retail data releases. Investors are actively repositioning portfolios to brace for data that could trigger policy shifts or volatility. Financial sentiment is teetering between optimism driven by easing inflation and caution over persistent core inflation trends. This delicate balance continues to drive tactical hedging and cross-asset rebalancing. Economic data in the coming days will likely determine the next leg of market direction.